Hello and welcome viewers. Today's a special one. It's a PSU bank where there's been a very large turnaround, as has been the case with many, but this one trades at a premium even to other PSU banks in the country. And we're going to be talking about Bank of Maharashtra today. Came out with their numbers not so long ago, less than 3 to 4 days back. And what we've seen on the stock price, this is the last 12-month chart that we've seen. 58% in terms of returns, but it doesn't end there. And it's not too often that we say that. Let's pull up the 5-year chart on a Bank of Maharashtra, and what you'll see is it's a multi-bagger. It's nearly a 10-bagger. In fact, in terms of the 5-year chart, at one point of time it was priced at rupees 12 per share, if I recall right. Currently sits at nearly 80 rupees a share. And even now, the price to book is not, in terms of the book value itself, it's at 40 rupees a share, and it does nearly 10 rupees a share of EPS. And there's a very strong compounding play which is playing out. Now the question therefore lies as to whether this kind of compounding is sustainable and how should we pencil in the kind of metrics that we're seeing. Even in terms of guidances versus what they are clocking, it's far better than what they are guiding for in terms of the management. And we'll have Ms. Neetu Saxena, who's the Managing Director and CEO, join us and give us that perspective. But as always, let's take a bit of a step back. Let's try and give you an overview with regard to Bank of Maharashtra. This was a PSU bank, 74% owned by the government of India, has a market cap of around 60,000 crore, and it's a large bank with a pan-India presence, but a predominant presence in West India is what it has. What does the bank do? Predominantly lending, and it does lending towards the cohorts retail, MSME, agri, corporate, and then thereafter a very small chunk of that is overseas. That's really the split. Based on FY26 final numbers. Retail is 30%, MSME is 18%, agri is 14%, and then 36% is corporate. So really that's the split. In terms of the sector-wise exposure, let me quickly pull them up. And this is of course only the top sectors. Infra is around 19% in terms of sector exposure. Housing is around 17%. Agri is around 14%. We spoke about agri, by the way. NBFCs plus public financial institutions is 8%. Trade is around 5%, professional 3%, gold 3%, so very small chunk. Gold could be one of those levers. Metals and products and real estate is 4.5%, and then there's others, where 26% of the loan mix resides. Let me talk about branches. Around 2,800 branches is what it has in terms of presence. Metros are around 700 branches, urban is around 600, and semi-urban is around 830, and the balance around 600 odd is rural. So really that's the split in terms of branches. Geography. It has a presence predominantly in west and central, and what you'll therefore see is Maharashtra is the predominant state, 42%. Madhya Pradesh is 7%. Uttar Pradesh is 6%. So that's the split, and this is percentage of total branches of 280. So really that's the tilt in terms of branch count. Then you have Gujarat, Tamil Nadu, Karnataka, Haryana, Punjab, and West Bengal, which have anything between 3 to 4% in terms of presence. It has a presence in nearly every state in the country. So in that sense, it is very, very well diversified in terms of the print. But when you're looking at the concentration, 50% comes from Maharashtra and Madhya Pradesh. If I add UP, that's around 55 odd percent. Maharashtra, Madhya Pradesh, UP. But really now the story, what's played out on that stock chart, and let's pull up the financials, and what you'll see is exactly why the stock has been a multi-bagger. You look at the net interest income growth, it's been 23%, and you'll see the kind of trajectory. It's been very steady in terms of the upward clip. Here we've given you the 4-year CAGR, and it's been a continuous upward climb with regard to the growth. So it's been very strong. When you're looking at the FY26 number itself, that is at around 19% CAGR. Operating profit also has done very well for itself. It's grown at around a 20% kind of clip. You're looking at provisions which were at 3,000 crore at the end of FY22. It's at 3,800 crore at the end of FY26. So you've not seen a real spike in terms of provisioning, and the net profit has grown at a very, very strong fashion, and that is because of there not being a lack of, or there being a lack of an increase in provisioning. So from that sub 1,200 crore number, very low base, net profit has now hit 7,000 crore for the current year. So we've seen a very strong clip of growth in terms of profitability as well. Let me talk about growth in terms of advances. And we've seen nearly 20% in terms of growth on the advances front. Deposits also have grown at around 15 odd percent. So we've seen a very healthy clip in terms of growth on advances and deposits. Those numbers are in lakh crore, as you can see, and you're now sitting at around 3.5 lakh crore in terms of the balance sheet. When you're looking at capital adequacy, that stands at around 18.5%. So it's well capitalized as well, and it continues to churn a very, very healthy kind of ROE metric. And I'll come to the ROEs. But let's talk a little bit about the yield on advances. When you're looking at the yields and some of the other operating metrics that we look at, the yields currently sit at around 9% odd. The margin number is at around 3.9%. The guidance for the margins is 3.75. They've done 3.9 nearly for the current year. Cost to income, the guidance was sub 40. They've achieved that. 37% is what they've done in terms of cost to income for the current year. Cost of funds sits at around 4%, which is best in class, right? Really, there's no concern with regard to that. And you're seeing an ROA as a result of that of 1.8%. Yes, that's a PSU bank clocking an ROA of near 1.9%. They've done 1.97% exit FY26. So all thumbs up here. No concerns whatsoever with regard to the operational metrics of the bank. When you're looking at gross NPAs, they've come off sharply from 4% to 1.5%, net NPA from 1% to 0.13%. Really, it's been impressive in terms of the journey itself and the consistency with which they've clocked that journey. So again, very positive. With regard to ROEs, they were at 11.5% FY22, currently sit at 23%. This is the fourth straight year where a PSU bank, Bank of Maharashtra, has clocked an ROE north of 20%. And hence you'll see the premium build up in terms of the valuations as well. So very, very strong growth in terms of profitability as well, which has aided the return on equity. Let me talk about shareholding. 74% held by the government of India. Earlier, it was 86%. This could have been a concern at one point of time. But what they've done is they've diluted, and as a result of that, what has played out is FIs, DIs have participated in that dilution. Public continues to own around 7 to 8%. But as a result of this, minimum public shareholding is met, and therefore that concern goes away. And that's why this comes up as a thumbs up on our list as well, because you no longer have the obligation to dilute any further, even though the government can do so if at all they want to at the right price. But there's no obligation anymore. There's no pressure anymore with regard to that dilution. That is now behind them. And that's the other positive which is playing out. Let me talk about the analyst view. 5 analysts track this one. All 5 have a buy call, no holds, no sells, 15% upside is what they see. Now I want to talk about valuations a little bit. Let me try and give you the full picture. Currently, it trades at around 1.6 to 1.7 times 1 year forward. And it trades at around 2 times trailing 12 months. It trades at 40 rupees a share and does around 9 rupees of EPS. And therefore, at around 50, the price to earn, price to book value 1 year forward could be around 1.6 to 1.7 on a conservative basis based on profitability of the current year and based on EPS of the current year. Some of the other banks, and Indian Overseas Bank trades at 1.9 times. You've got UCO Bank trading at 1 time, and this is all current, right? Bank of Maharashtra trades at 2 times current. Some of these trade anything between 1 to 2 times current book. And you'll see Yes Bank trading at 1.2 times. That's a private sector bank. 0.9 times for Bank of Baroda. Indian Bank trading at 2 times. PNB trading at 1 time. Punjab and Sindh trading at 1.3 times. So this one trades at a significant premium to the others. But when you're judging it by ROE, it also makes up for the premium that it trades at. Now, let me bring on board, in fact, Nidhu Saxena, who's the Managing Director and CEO of Bank of Maharashtra, to take this conversation forward, try and understand maybe how the next 12 to 24 months, plays out with regard to the bank. Mr. Saxena, great having you. Let me first start off by trying to understand that deposit growth of 9% that you've clocked on a QOQ basis. You've done extremely well on that count, right? It's been a very, very strong kind of performance. Talk to us about what's led to that kind of performance and whether there were any one-offs there. Give us a perspective of that.
So, Harsh, good afternoon, and I think very holistically you have touched upon the bank's journey of the recent past and touched upon not only the growth metrics, the asset quality, the profitability, the capital adequacy, and how we have been performing on the capital raising front, and how we have gone ahead with strategically diluting the GOI holding from 86.5 when I joined and 7% with LIC to now we are 73.5, 74. So, and which has really played out well. The FII and DII participation from 0.39 3 years back is now 5 plus. And that's a decent gain. We have seen participation in terms of number of investors also going up from 38 FIIs, NRIs to 198. Likewise, DIIs also, mutual funds also have looked at the stock very seriously and participated. So all of this has slowly, steadily only giving the re-rating. The bank stock, if you look at the performance it deserves, I think we are gradually on that path. So what is happening is that when we are looking at growing the top line, we are very, very mindful of two things: that with every corresponding growth in the top line, how the bottom line is correspondingly increasing, how the various metrics we just talked about, ROA, ROE, NIM, how they are behaving. So we are mindful of all that, and there is no compromise in the quality of the loan book. Coming to your specific question regarding the 9% Q-on-Q in deposit. So deposit, when we look at deposits, we see there are two components of deposit. There is the institutional deposit, there is the core retail deposit which happens in the branches. So we have, our understanding is very clear. We have a different strategy required for institutional clients and for retail clients, and the understanding is very clear. They have specific needs, and that's how we address those needs. And in a very focused manner, what differentiates me from the other banks, that we have a dedicated vertical which takes care of these two elements: the institutional CASA, the core retail CASA, in a different way. So we have developed new products. We have done the technology part. My mobile banking application, which has been launched 7 months back, it has seen 5x the peak active registered users that we were having in the old version, which ran for 7 years. So, which is a big fillip, and we have new products which are introduced to cater to the needs of every segment of the CASA, that business that happens in branches. In terms of institutional, as I said, a dedicated vertical looks at the requirements, they do their engagements, and they look at their specific needs, and we give some value additions looking at their needs. And all this put together is actually playing out. And there is one more thing you would have observed, that my growth rates across parameters are far ahead of what the industry paces. So there is one thing I would like to mention which differentiates the bank from the other banks. We are very aggressively on the path of new branch opening. While you mentioned that 42% of branches are in Maharashtra, this ratio in 2019 was 58-42. So 58 within Maharashtra, 42 outside Maharashtra. The ratio has now, after the last 3 to 5 years branch openings, the ratio has simply turned. 42 stays here. Not that Maharashtra is not important. We have a complete realization that Maharashtra is the state which contributes to the maximum to the nation's GDP. But when we look at our branch presence, I think we are adequately represented in Maharashtra. So the next branch opening plan, which was under 1,000 branches to be opened in 5 years, board approval.
Right.
We are currently running a project. We call it Project 321, where 321 branches are getting opened in 18 months, and very scientifically selected, looking at the potential growth centers of the country and down to the pin code level. So a lot of data points from CICs, from the RBI, using certain algorithms, we have listed these branches. So very scientific branch opening, wherever new growth centers in the country, we are increasing our presence. So this all put together, the aggressive branch opening is actually sustaining, and this will sustain me for next 2-3 years. This kind of high growth rate, more than the industry average.
I take your point, Mr. Saxena. You've given us the whole picture, and it's a wonderful picture to see, but I want to break this down a little bit more. So this deposit growth of 9% QOQ, let me first try and zoom in and close that loop. That there are no one-offs in that, and it's not end of the period deposits or any one-offs which are sitting there, which is kind of spiking your deposit growth for Q4. Am I right?
Yes, that's right. In fact, at some point of time in 2025 first month, what we had seen that our contribution of deposit franchise was very high from the bulk side, and which was high cost. So very consciously we were reducing this element, and we have gone down to look at the DRI, where some incentives, if at all, are given. So we went on to reduce from 13.08 to 5.08. And thereafter, what we have seen that focus is purely on the low-cost component of the deposit, and we have looked at some alternate sources of raising resources. While bringing my bulk share to so low, especially the DRI portion of it, then Q on Q, my bulk deposits have grown. Because what we have seen, CASA is a constraint. The industry CASA, if you see, at some point of time, average used to be around 44, has come down to 36, 37, even lower for some banks. So we looked at refinance, we looked at raising resources through intra-bond, and then we allowed Q on Q bulk also to come in. But as I said, we have reduced drastically our bulk, and that's how you will see my cost of funds, cost of deposits on Q3 and Q4 with repricing benefit coming in has actually come down 40 bips and 18 bips in Q3 and Q4. And that's how the overall cost of deposits also have come down.
But that's sustainable, right, sir? Because on the 18% growth that you're doing, your loan to deposit had spiked at least at the end of Q3. Now that has leveled off. Give us some color around the sustainability of some of those numbers. Your cost of funds are now nearly 4% or 4.1% odd for the full year as well. So you believe that that number is sustainable?
So yes, our all strategies that were in place and this dedicated vertical, which is now green shoots have been shown. We have marked certain 5 focus states where we are able to establish new institutional relationships, and we are only strengthening the vertical further going ahead, and we will continue to get this kind of attraction. And with this new branch opening, as I just mentioned, the numbers of branches that typically on an average 200 branches I have opened in 1 year. So incrementally, whatever that branch business is happening is adding to the business of the bank, and where the base is zero actually. Base is zero. And the focus to zonal leaderships is the core business that is happening in these branches, retail core deposits, both CASA and term deposits from retail individuals is what their KRA is. So that's how I will see sustainability in this number. I don't foresee a challenge. If you look at my deposit franchise and deposit guidance for the next year also, we did 14%. We are maintaining a guidance of 14 to 15% for the current FY also. Yes,
I saw that. With regard to margins, therefore, sir, you are doing 3.91% on margins, Mr. Saxena. No reason why you should be guiding for 3.75 when you are doing 3.91% in an environment like this. Is this just conservativeness? What's playing out in your mind?
So Harsh, you rightly, if I look at last 2 years, my guidance on NIM has been maintained at 3.75. Yes, we may sound conservative, but today when I look at the participation of investors, all stakeholders, government, RBI, and whatever guidance, typically 15 to 16 parameters that we share at the beginning of the year, we are completely committed to it, and we would like to deliver more than the guidance so that the comfort stays with the investors. But as you say, see, looking at the concerns around the low-cost deposits, which is still playing out in the ecosystem. All the banks are finding it an area of a severe competition. So we want to remain conservative, yes. But we would definitely, if you see Q1, Q2, Q3, Q4 for the last financial year, my NIM actual achieve was 3.95, came down to 3.85 in the Q2, went up to 3.87, and we have closed the year with 3.95. Overall has been 3.91. So, but we still like to maintain this 3.75, and we are committed to this number, and we would be looking to give a performance actual which is above the guidance number.
Two questions, and these may be concerns. I want to first start with the portfolio itself. Agri, to a certain extent, has been one of those possible, if I can call it, pain points for you, Mr. Saxena. And there's plenty of drag, because one, you have West Asia, which is a problem at this point, and that could drag both MSME as well as Agri for you. The other one is the weather. The weather is not expected, or the rainfall is not expected to be at 96 to 98% long period average, which is a far better number than the 92% which we are currently looking at. Do you believe that those could be possible concerns on the portfolio, at least in the near term?
Absolutely, Harsh. Whatever is happening in the ecosystem, we are operating in the same environment. We are also part of the system. So anything at the economy level, the impact will be. But when these kind of events are happening, we are mindful. We are monitoring closely the portfolio. Yes, there is a forecast of 8% deficit monsoon. So the regions where they are predominantly rain-fed activities, we are mindful of that. But if you see in agriculture segment, what we have done last year, we have started to attempt a rebalancing of the portfolio. We have moved from vanilla production credit to investment credit, taking some big ticket exposures, 25, 30, 40, 50 crores, because you can go up to 100 crores. So what regulator permits. So the idea is, when we are entering into financing warehouses, cold storages, and big ticket farmers, we are also able to get some collaterals and securities around the exposures. We get some ancillary business around that. And we have seen that the pain point sometimes in the low ticket size, which is there, production credit alone, when you move your agri book with, you will find issues. So not that we are not doing, we have the small ticket production credit KCC loans, we have entirely moved to the digital journeys. So there my staff involvement is very minimal. We have business rule engine which drives the production credit, and seamlessly for low ticket agri advances based on rules, the underwriting and disbursement also is happening. So those kind of technical digital capabilities are already built in the system, and our effort to take on investment exposures in agri is actually becoming overall ensuring that the agri loan book is of quality borrowers, where we have collaterals and some ancillary businesses, and we will be managing the stress going forward. My agri NP also has come down, which is the highest in the agri book. But I'm also one side I can my PCR stands at 98.59, which
That's
is a
correct.
high provision coverage. Now even my agri book, I mean, it's well covered. So we don't foresee a big challenge to us. But yes, we are mindful of these elements. Even the production credit, we have the risk mitigation of the Pradhan Mantri Fasal Bima Yojana, where insurance coverage is available to the portfolio. So to a certain extent, we are guarded, but we are very mindful of all these developments and take our suitable steps around that.
I take your point, Mr. Saxena. The last piece, sir, is to try and understand the ROA trajectory. Therefore, you've done 1.97%, which is honestly equivalent to some of the larger private sector banks, right? Or even beating some of them. Give us a sense, what could harm sustainability of this number, and therefore why are you guiding for 1.8 while you're doing nearly 2% ROA? Because I don't hear as many risks to this story outside of macro.
Yes. So, as I said, these are numbers or metrics where the stakeholders very carefully watch how the company and how the MD quarter on quarter is coming with the quarterly results and sharing the guidance and how they are performing against the guidance that is being shared at the beginning of the year. So 1.75 has been my guidance for the last 2 years. We have been performing, and you rightly pointed out that my Q4 ROA is 1.97, barely almost touching the 2. And we would like to gradually move into that bucket of ROA having 2 and more. So, but this is one metric where we have upped our guidance number from 1.75 to 1.80 is the guidance for FY 26-27. We will remain committed to this increased ROA guidance that we have shared. We know what are the numerators and the denominators, what are the components that are going to contribute in this higher ROA that we have given guidance for, and we feel that we will not have any challenge. We also are a bank in the FY 25-26. We had a stock of 1,500 crores of accumulated losses that we had actually consumed by H1 of the FY 25-26. We have no further accumulated losses. 930 crores is around my tax liability, for which we have 100% provided. TDS has been deposited. So incrementally, I'll tell you why the ROA we have confidence will not be a challenge to maintain and in fact to improve, is that for the last 2-3 years, taking cue from the guidance from the regulator that these are the benign phase, these are the good times, we should keep creating cushions and buffers. So at the rate of 200 to 250 crores, we have been already only building extra provisioning over and above the IRAC norms. I currently hold around 2,500 crores in my balance sheet. So this incremental provisioning that I am doing, I can just keep provisioning now for the income tax provision, and that's how I will see that ROA is not going to get impacted anyways.
Right. Mr. Saxena, it's been a pleasure, and it's been very nice analyzing this, as well as it's been great just watching the story unfold as well over the last few years with regard to Bank of Maharashtra. I wish you all the very best, and of course I'll continue to be in touch with you going forward in quarters as well. Thank you so much for joining us.
Thank you.